The information provided in this video is for informational purposes only and reflects the personal opinions of its creator. It should not be considered legal, financial, or investment advice. If you're considering starting a venture capital fund or engaging in fundraising activities, you should seek professional legal assistance to ensure compliance with the laws and regulations of your country. Raising capital for a venture capital fund is not just about finding investors, it is about finding the right ones. Every limited partner, or LP, brings a different motivation, a different risk appetite, and a different expectation for returns. Some LPs are looking purely for financial upside, while others are in search of strategic benefits, access to innovation, insights into emerging markets, or even early M&A opportunities. For a venture firm, understanding these differences is crucial because the LPs you bring in will shape the way the fund operates, the type of deals it can pursue, and ultimately, its long-term success. One of the most sought-after sources of capital in venture is family offices, privately managed investment entities that handle the wealth of ultra-high net worth individuals and families. Family offices have become increasingly active in venture capital, drawn by the potential for outsized returns and the excitement of backing innovation. What makes them particularly attractive as LPs is their flexibility. Unlike large institutional investors, family offices are not bound by rigid investment committees or bureaucratic processes. They can move quickly, make decisions based on relationships rather than rigid portfolio allocations, and often have a long-term perspective. Some are purely financially motivated, while others are looking for investments that align with their personal interests, whether that's climate tech, AI, or next-generation healthcare. Many emerging VC managers find their first backing from family offices, not only because they are willing to take risks on new funds, but also because they value close relationships with fund managers who can provide direct access to promising startups. At the other end of the spectrum are pension funds, large, highly structured investors that allocate capital across a range of asset classes, including venture capital. Pension funds manage vast sums of money, often in the billions of dollars, and they need to balance risk carefully. While their capital is stable and long-term, they tend to be far more selective about where they invest. Pension funds typically look for well-established VC firms with multiple successful funds under their belt, rather than first-time managers. Their due diligence process is rigorous, often requiring a track record of consistent performance, strong governance structures, and clear risk management strategies. When a venture firm does secure pension fund backing, it is a major validation, signaling to the market that the fund has institutional credibility and is seen as a reliable steward of capital. Another category of LPs is corporate investors that invest in venture funds as a way to gain access to innovation. Unlike pension funds, which are strictly financial investors, corporates often have strategic objectives when backing VC firms. They might want early visibility into emerging technologies that could impact their industry, or they may be looking to develop partnerships with startups that could become future acquisition targets. While this kind of LP can bring tremendous value, helping portfolio companies with distribution, product development, and market access, it can also come with strings attached. Corporates may seek preferential investment rights, co-investment opportunities, or even veto power over certain deals, which can complicate the independence of a VC firm. Managing corporate LP relationships requires a careful balancing act, leveraging their strengths while ensuring they do not exert undue influence over fund strategy. Then there are fund of funds, or FOFs, investment firms that specialize in backing venture capital funds rather than investing in startups directly. For a new VC fund, securing a fund of funds commitment can be a game changer, as these investors are specifically structured to evaluate and deploy capital into venture firms. Unlike family offices or corporates, which may see VC as just one piece of a larger portfolio, fund of funds are deeply embedded in the venture ecosystem, with a mandate to identify the most promising fund managers. They also tend to invest across multiple fund cycles, providing long-term stability for VC firms that establish strong relationships with them. However, they can be highly selective, often demanding favorable terms in exchange for their capital, such as lower management fees or co-investment rights. Among the oldest and most prestigious sources of venture capital funding are university endowments. Institutions like Harvard, Stanford, and Yale have long been active in venture capital, recognizing that investing in innovation can generate substantial long-term returns. Endowments have particularly long investment horizons, often measured in decades rather than years, making them well-suited for the extended timelines required in venture investing. However, like pension funds, they tend to favor well-established VC firms with proven track records. Breaking into this category of LPs can be challenging for first-time managers, but those who do often benefit from a highly respected investor base that signals credibility to the broader market. Finally, one of the most dynamic sources of LP capital comes from successful startup founders and high-net-worth individuals. Many of today's venture capital firms were originally funded, at least in part, by entrepreneurs who had successful exits and wanted to reinvest in the startup ecosystem. These LPs are particularly valuable because they bring more than just money. They bring deep networks, operational expertise, and credibility. Founders turned investors understand the challenges that startups face, making them excellent advisors and connectors. They also tend to be more open to taking risks on emerging VC firms, since they themselves have been on the receiving end of venture investment and understand the high-risk, high-reward nature of the business. For a VC firm, building the right mix of LPs is not just about securing capital, it's about creating a long-term partnership with investors who align with the firm's vision, investment strategy, and risk appetite. A well-balanced LP base provides financial stability, strategic value, and credibility, allowing fund managers to focus on what they do best: identifying, backing, and scaling the next generation of groundbreaking startups. Venture capital firms must carefully select their limited partners to align with their investment strategy and long-term vision. Different LPs, from family offices and pension funds to corporates and university endowments, bring unique advantages and challenges. While institutional investors offer credibility, they require a strong track record, whereas family offices and founders bring flexibility and industry expertise. A diversified LP base ensures financial stability, strategic value, and the ability to focus on identifying and backing the next generation of groundbreaking startups.